So when we are appraising projects, the next thing we want to look at is the net present value as a method. Now, as the name suggests, it means that here we are discounting the cash flows on the project into present terms so that we can determine whether we should undertake the project or not. The decision rule is pretty simple here. It's direct, straightforward. If we do the workings and we realize that the NPV of the project is positive, that means the project will maximize the wealth of the shareholders, and so we have to accept that particular project. On the other hand, if we perform the NPV schedule and we realize that no, it is giving us a negative NPV, it means this will actually decrease the wealth of the shareholders, wouldn't give us any returns at the end of the day, and hence we are going to reject such projects. So under the NPV, the decision rule is very simple. If it is positive, we accept, we proceed, we continue with the project. If the NPV is negative, it means that we ignore the project and do not proceed with the project. Reject the project here. But it is important we understand that doing the NPV, there are a lot of things that we have to be mindful of. So we're going to be dealing with some basic issues that we have to understand. Unlike the accounting rate of return, discount payback period, and the discounted payback period, where we were just looking at some minimal things, here we are actually going to be taking into consideration a lot of issues. Bear in mind also that definitely the marginal costing principle is still chasing us here. So we are interested in the relevant cost of executing or undertaking the project. So any non-relevant cost, sunk cost, committed cost, non-cash item will still not be considered here. And so to really work ourselves out for the net present value, there are a couple of concepts that we need to really understand. The first one is dealing with the effect of working capital. For whatever project the entity undertakes, it is going to require some working capital. The question we ask ourselves is, how do we account for the working capital? We're going to be getting into that in a moment, so we see what we can do. The second thing is the issue about taxation. If you remember, the last three methods that we spoke about, there was nothing about taxation. But every project will have some tax consequences. And so we need to be able to talk about the tax issues as well in the project. The third thing is that cash flows are going to be in real terms. And we'll get into this in a moment. We're going to be looking at the effect of inflation as well, taking into consideration inflation when appraising the project. The fourth thing, it's going to be the discounting factor, or if you want, the discounting rate. It is important we understand the principle that underlies this so that we know exactly what we need to do at the end of the day. So these are a couple of concepts that we have to understand, and let's take them one after the other and share our thoughts on them. First is working capital management, or working capital to be simple. The idea about working capital, as I mentioned, is that yes, as we undertake the project, we will require some money to run the day-to-day affairs of the project. There is a simple concept here that all working capital outflow must come in as an inflow at the end of the project. That is the basic assumption we apply. All working capital outflow will be recorded as inflow at the end of the project. This is the basic assumption. So once we have working capital, as far as the entity is paying for that, that working capital is an outflow. But at the end of the project, it's going to be coming as an inflow. That is the basic assumption on working capital. So the question we then ask ourselves is, how do we actually account, like how do we deal with this? How do we account for this? So we go back to our investment appraisal documents that we have been referring to, and then go to page 16, working capital management, and want to look at example 3 and use that as a guinea pig to explain the concept of working capital. The requirement here is pretty simple. We are supposed to calculate the net cash flow for each of the years in question. So let's see what we got. A machine costs $15,000 and is expected to last for 4 years with a scrap value of $2,000 at the end of year 4. So the cost of the asset is a relevant cost, RC. The scrap value 2,000 is also a relevant cash flow because that will be an inflow at the end of the project. Now the project life here is 4, so I can set out my NPV schedule here, and I'm going to have year coming up 0, 1, 2, 3, 4. We're going to slash in our currency sign. And bring in the various items. The first thing is the cost of the machine. So we bring it in there. So the machine cost $15,000. That's going to be in year 0. That's going to be in year 0. Then the scrap value, which is how much we're going to sell the asset at the end of its economic useful life, is $2,000, and that will be under year 4 as an inflow. So $2,000 as an inflow in year 4. Right. The sales revenue and operating cost for each of the 4 years has been estimated as follows. So we see the sales revenues, so we bring it up. So sales, and that is respectively 5,000, 11,000, 8,000, and 9,000. So 5,000, 11,000, 8,000, and 9,000. This is revenue. Then operating cost, 2,000 throughout. So we bring that in, operating cost. Now that is an outflow, so we're going to put that in brackets like that. Next, working capital of 10% of the year's revenue is required at the start of each year. Now, the principle is that if we're going to need money at the start of a specific period, then it has to be provided for in the previous period. That is the rule. If we will need money at the start of a period, we will provide for it in the prior period. So with the 4 years we have here, what it simply means is that the working capital we need for year 1 will be put under year 0. The working capital for year 2 will be put under year 1. The working capital for year 3 will be put under year 2, and then the working capital for year 4 will be put under year 3. That is the meaning of this statement. When we need cash flow, we have to incur a cost. at the start of a specific period, we recognize it in the prior year. Now, the rule here is 10% of each year's revenue. So I'm going to put in my working capital here. But the truth is that we have to work for that. So going to have the workings in, have the year coming up, 0, 1, 2, 3, 4. So we're going to have the sales respectively coming in like this. Then we work for the working capital requirement. They said 10%. 10%. So 10% of 5,000 is 500, 1,100, 800, and 900. But this is the principle you have to understand. And that takes me back to my explanation here. Note, where working capital is required over the life of the project, it is the incremental working capital that is recognized for the subsequent years. This is a principle where working capital is required over the life of the project. It is the incremental working capital that is recognized for the subsequent years. So if I come back to my workings here, although my working capital are these respectively, these are not the figures I'm going to put here. So I have to work for the incremental working capital. So incremental working capital. Note, they said it is required at the start of each year. So the 500 that is required at the start of year 1, we have to provide for it in year 0. So it's going to come under year 0. That's the first year. Now, back to the rules. What did we say? It is the incremental working capital that is recognized for the subsequent years. So for the subsequent years, we don't bring the 1,001, we bring the incremental, the change. So 500 has now increased to 1,001, giving us a difference of what? 600. That is what will come to year 1. Then from year 2 to year 3, it reduced to 800, giving us a difference of 300. Now, reduction means inflow. So we're going to leave that as positive. Reduction, it means inflow, because if you check, it was 1,001 in year 2, but it reduced to 800 in year 3. Hence, there is a reduction in the working capital requirement, and that is an inflow to the entity. Then it increased from 8 to 9 in year 4. That will give us an outflow of 100. Now, if you add that up arithmetically, it brings us an inflow of 900 at the end of the project, which goes back to the principle we stated, that all working capital outflows will be recorded as inflows at the end of the project. So now, if you add up arithmetically, negative 500, negative 600, plus 300, minus 100, it gives you negative 900. That will come as an inflow at the end of the project. So this is what we now take as our working capital to the NPV schedule, respectively to the NPV schedule. So that is what we must understand about working capital management. All working capital outflow comes as an inflow at the end of the project. Number 2, where working capital is required over the life of the project, it is the incremental working capital that is recognized for the subsequent years. And that is how we deal with the working capital. Once we have the working capital, we can get the net cash flows, which is the requirement of the question for us here. So this is going to be 15,500, then 5,000, 2,000, 600. We have 2,400 positive. 11,000 minus 2,000 plus 300. That is 9,300. 8,000 minus 2,000 minus 100. 5,900. 2,000 plus 9,000 minus 2,000 plus 900, and that is 9,900. So that is the first rule we need to understand when it comes to net present value, how we deal with working capital requirements on the projects.